They plays the Johnny Carson theme song music. Comes on. Okay.
I might splice that in. You never know.
Okay.
Hey everyone, it's Rachel here with your Tech Talk Tuesday from MarketEdge.com. I've got with me this week David Blake, our resident expert, who's going to tell us about what the market was doing last week and a little bit about what's going on this week. David, how are you today?
I'm doing well, Rachel. Thank you.
Awesome. Let's get into it.
Okay. Well, last week, the Fed officials kind of declared the U.S. economy a little bit too hot to handle for their tastes, and yields obviously went higher, and as yields are moving higher in this market, equities moved sharply lower. That started on Tuesday after we came back from the long weekend, and investors started heading for the sidelines. We had the worst daily losses for the major averages since mid-December. The Dow fell almost 700 points on Tuesday. The S&P 5 actually slipped negative for the year on Monday last year. NASDAQ sank 2.5%. And people were just a little bit jittery going into the FOMC meeting minutes. We've had a couple of the Fed governors, saying rates need to go higher than what the market's kind of expecting. And when the FOMC meeting minutes came out on Wednesday, they really didn't do much to calm the market. And it was kind of what the Fed Powell had said earlier in the week previously, and the market just kind of went sideways, a little bit down. We did get a little bit of a one-day reprieve with on Thursday when Nvidia came out with their earnings. They had a heck of a report, talked about AI and all, and the stock jumped 14% on their earnings. That sent the Philadelphia Semiconductor Index up about 3.3%, and I think we're up a couple hundred points on the different major averages. That is a good sign. People want to see a little bit of a bounce. But then on Friday we had the January PCE index, which is the Personal Consumption Expenditures Index, which is what the Fed, it's kind of their go-to as far as how the progress they're making on inflation goes. And the PCE went the wrong way. It actually moved higher, showing inflation had strengthened in January. We had the core PCE jump 0.6% month over month. They were only looking for about 0.4, and it was up 4.7% year over year, and that also was above consensus. So, and the inflation numbers did go the wrong way. That was not what the market wanted to hear. We sold off pretty hard at the open. We had rates move up again. The 10-year Treasury rate went as high as 3.947, which is the highest it's been since 2007. And then we had the 2-year push up to about 4.80. The firmer the rates go, the higher the U.S. dollar goes, and that jumped its highest mark since last November. So that also was going the wrong way for equities, and so we kind of just sold off. Buyers went to the sidelines, stayed over there. We had several analysts come on last Friday talking about, what are we going to do? We have to get these rates higher. And, the market was kind of expecting to get to a Fed funds rate of maybe 4.75 to 5. And they started talking last week that maybe we need to get to 5.5 or higher and leave them there longer. Before that, we were having different analysts talk about, maybe we're going to have a hard landing or soft landing. Maybe we have no landing, not going to recession. But as the yield curve continues to change, we certainly are more inclined to say that we're definitely going to have some kind of recession towards the end of the year. We do get some resilient numbers occasionally that we'll see the market. We'll get some good numbers. Actually, the market will go up. That's on hopes that a recession will be light. But as some of these numbers start coming in weaker and weaker, we're actually going to end up with probably pointing more towards the hard landing. And when you have the inverted yield curve, I think it's as inverted as it's been since back in 2000, I believe now. That just more and more chance that we're going to have a harder landing on that. Now, I think every energy eked out a small gain last last week, very, very small. And then as far as the sectors that were red, REITs, technology, consumer discretionary, communication services, the figures, the growth sectors were the ones that got hit the hardest. As far as the technical condition of the market goes, it again deteriorated last week. The different indexes were sharply lower. All the technical indicators that we follow are basically in negative territory. MACD, which a lot of you probably look at on the charts, that's more of a short-term trend gauge. It's firmly in bearish ground. Upside momentum. We kind of look at the 9-day or the 14-day on that. I usually refer to the 14-day on that because there's other things I look at in that. It continues to weaken. We're not getting, just not getting those bounces or those little, you get down, get the oversold rallies. And we also came down where we looked to try to find support at some of the key moving average levels. By that, when I mention those in the letter, I'm talking about the 50-day moving average, maybe the 100 or the 200-day moving average, and all three of the Dow, the S&P 500, and NASDAQ are all basically looking at one of those index moving average lines right now for support. We talked about the S&P 500 since that's the most widely index that we follow. It's kind of the bellwether. We wanted it to try to hold that 3980, 4,000 level. That would be good. We actually broke below that, I believe, on Friday. The next level below that would be the 50% retracement of the December to February rally that the S&P 500 and NASDAQ put in here, and that would take a support level down to 3920, 3940. However, as I said in Friday's letter, even though we broke below some of these key moving average levels areas, if we can bounce back within a day or two, that's a positive for the market. And I think that perhaps until we get some more, until we get some of these yields breaking resistance to the upside, maybe we can, if we're lucky, we can get some of these different indexes to trade in a, kind of a side range, narrow ranges, just until we see whether these yields are going to break higher or whether maybe they're going to top out right here, and we can start to see the inflation progress, and maybe we get some buyers starting to come in, sneak in there a little bit. As far as underlying breadth goes, that was negative last week. We did see the advanced decline lines were showing pretty much broad distribution. I think the NYSE advanced decline line lost about 2,300 units. The NASDAQ was worse than that. It dropped about 4,500 units. And we also, we did get, as far as the NASDAQ goes, we had more new lows than new highs during the week, which is the first time we've had about 4 or 5 weeks there where we're getting more new highs, which was a positive, but that went away last week. As far as the Dow Jones, even though it's the weakest of the indexes right now, we actually still had more new highs and lows last week. So that's something just, if you're trying to look for something to hang your hat on, that might be it. As far as the industry groups go, we're still getting, as far as relative strength goes, coal, internet software, advertising, building materials remain strong. The weakest industry groups right now are internet content, communications. That would be like your Netflix and your Google. They're in that group. Retailers, drug-based, and precious metals. You've seen a lot of, if the rates are going to keep going higher, and the dollar firms up, it's not good for precious metals. So you've seen gold tick down from, I think, around the 1900s up down to like 1820 or something like that. As far as ETFs go, the strongest over the last week were shorts, of course. Then we had commodity agriculture and commodity base metals. They outperformed. And on the weak side, you had the alternative energy stocks were hit pretty hard. So internet stocks and especially financial stocks. And at some point, we should start to see these financial stocks with rates up like this start to outperform, because they have such a spread between the long and short-term rates going out there. So that's something we'll look at. Okay, as far as the new week goes, yesterday we did get a little bit of a bounce. We came back from the weekend. we're a little bit oversold. Some of the indexes were down in the the teens as far as the stochastics go. People were, they were kind of trying to shake off some of the inflation numbers. We saw the Dow Jones jump 370 some points early, but they sold the rally. We came back almost to even, and they kind of moved in a little bit towards the last hour or so, and we were able to finish positive. Not great, but Dow had 72 points. I think the NASDAQ also picked up 72 points. It outperformed. The buying was going on, not sure why, but it was going to consumer discretionary, industrials, and technology. They led the rebound. And defensive sectors were actually the laggards. That includes utilities, healthcare, and consumer staples. It's funny because today we're seeing mixed numbers today. And again, the defensive sectors are lagging. That's again, utilities and healthcare, consumer staples. That's interesting to note because there's a couple of reasons for that, I guess. Number one, as rates go higher, some of these defensive sectors are not quite as attractive because a lot of times you're going to buy some of them for their dividends. So we'll see what's going on with that. Okay, we actually had, we were up yesterday, got a little bit of that rebound, and we're actually pretty mixed today. We had some pretty good earnings numbers coming out today, that mostly positive. We had Target and AutoZone, Advanced Auto Parts, Builder's Source, Smuckers, MKS Instruments. They all beat. We did get a small miss from Norwegian Cruise Lines, but they said that they see people want to travel, so they expect their numbers to at least hold up going forward. And again, we, like I mentioned, we had the defensive sectors are lagging for a second day, with more of the growth sectors outperforming, helping NASDAQ outperform again today. As I mentioned, with one thing we're watching as far as earnings are going here, we're starting to wind down, but CNBC today said that twice as many companies have lowered guidance after reporting earnings than raised. That's something you don't see very often. But what it's pointing to you as an investor is that you're going to see earnings being cut over the next couple of weeks. We're going into March here, I guess, tomorrow, and probably the next 2 weeks we'll begin to see the earnings on the S&P being cut. That's going to, as they're being cut, that means it's going to be hard for the market to make any upside progress. Another thing today, despite we had some weaker economic data, that was the February consumer confidence fell to 102.9. They were looking for 106. And then we had the Chicago PMI eased further into contraction. That was down to 43.6 from 44.9 the prior month. So especially with the earnings, as earnings get cut, generally it's going to weigh on the indexes. Generally, when you come out of a slow period, like going from a recession like that, the earnings numbers are going to be down at 14. The PE is going to be like 14 or 15, and we're still up here around 18. So, if we're going to get down, if we're going to go to a recession and get down to around 14, 15, that's why you're seeing these people on TV start to say, we can see the market going down maybe to 3,600 on the S&P 500, or maybe 3,500 or lower. Again, if they keep cutting the earnings, that's you're going to have a contraction in the multiples in the market, and that's going to be hard for us to get to push higher. Now, the other thing that I saw today was we saw overseas, especially in Europe, that like the United States, February was a little bit more inflationary than what they saw. We're seeing upward inflation pressures in Europe. I think the United Kingdom said their food costs were up something like 15% year over year here in February. So that's kind of going the wrong way again, which means the European Central Bank will have to be raising rates also, which is going to have an effect on European markets too. So there's not a real lot of reason to be jumping in here and putting your money in the stocks at the moment. I do think that coming out of a recession, there's a lot of good that we're going to see. But right now, I think you just kind of choose and pick when you want to put some money in there. If you see something, because you do have some stocks. You had Tesla since the first of the year, basically doubled. You had Nvidia over the last month or 6 weeks, almost doubled. So when you see some of these stocks like that have great, going out 3-4 years, that you just think they can't get any lower. Maybe you nibble away. I wouldn't throw away into everything all at one time, but you might pick up a little bit here, a little bit there, and something that you want to keep for the longer term. So that's kind of where we are right now, and we'll see how it goes the rest of the week.
Great. Well, that's a bummer to hear how negative it's looking out there, especially as we end February and head into March, as the market tries to get a grip on those inflation and rising rates. So does that mean that the market will just continue to drift lower until we see the Fed pause? And, is there anything our subscribers can keep an eye on to help manage that risk here?
Or let's go ahead and go to the charts on the MarketEdge site. You can click on that. What I think you want to look at in here. Number one, today we had, as I mentioned, our rates originally ticked down, then they ticked higher on the inflationary data when Europe closed. So you had the rates on the 10-year. It got as high as 397, and when we came on here, it was 394. That's the highest it's been since 2007. Now, if you go to the charts, okay, we're at that. Now, this is the TNX, is something you can put up, and this is actually the yield. A lot of bond charts that you look at show the inverse. So they're pointing down, but as a bond chart goes down, that means the yields are going up. This TNX will show you the actual yield itself. And I think so we hit 397 today. There's resistance higher, and by higher I mean on the 10-year you could see resistance getting up here somewhere around 40, maybe 4.12. That would be the ultimate, but you're going to have psychologically when we cross above 4%, I think you're going to see have a sweep of selling go through the market. In the same way with right now we have, as far as the 2-year, the 2-year got as high as 4.837 today. Again, that's the highest since 2007. I think once you get above 485, 490 probably on the 2-year. I don't have the ETF on that for right now, but that's also going to cause a little sweep off on the equities. Now, if you can compare this, Rachel, put in a comparison up there. Put in SPY. Yeah. Okay, and make this about a 3-month, 4-month chart, whatever you want to. Okay, as you can see with this, okay, the SPY is the dark line, and the yield of the 10-year is the light blue line. And as you can see, they go in opposite directions. As yields start to fall back here, and we'll go back here looking at back last fall, as yields started to come down a little bit, when they started to say, okay, well, maybe we can pause rate hikes sometime after the first of the year, the rates fell back down to around I think it was around 4 or 3.4, 3.3. We got below 3.5%, and the market liked that. And then you can see we had that nice rally going into the first of the year on the blue line, where the SPY moved in the opposite direction. We went out and made new highs off of that. Okay, then when January comes around here, we started to see the rates coming down again, and then you had this continuation of the rally on this dark blue line. As you can see, we actually took out the October highs, November highs, made a new high there, just as we were moving into February. And then right about that time is when we had the February 1st, which is on the light blue line. You can see where it bottomed out. That was when the February FOMC meeting came out, and they announced that it looks like we're going to have to maybe, we're not going to be halting rates here. In fact, we're probably going to have to go above, push it towards 5% or higher to make more progress on inflation. And that basically was the top of where the SPY topped out right there. Then you saw this big, the rates start to tick higher. And as long as they're ticking higher, and we don't know where they're gonna stop, that put a stop to where the SPY, the S&P 500, where it topped out. But I think what you need to do, you kind of need to watch this TNX, especially in the 2-year rate, to see where they go. You can pull that up or go on your any website that you look at to see how they're moving, and then you kind of compare these two. And if you start to see maybe the rates start to tick down, you'll see where the support comes in on the S&P 500. But until we see something come to an end as far as the pause in the rates, it's going to be hard to make any progress on that. Now, one thing I wanted to mention, a lot of times you'll see our CTI has been negative for several weeks, and the market's been trending going lower. However, it hasn't been. We've held neutral, and there's several reasons for that. I wanted just to mention. Number one is that the cycles that we follow are coming close to where they should be bottoming. In fact, it could be this week or next week as far as our cycles go. And of course, you have outside influences. If all of a sudden we get some economic data where we see the rates tick up above maybe 5% on the 2-year and get about 4 1/8 or something on the 10-year, you're going to see the market pull back in. We'll start making new lows. And that'll extend out the length of these cycles. But I didn't want to go to an avoid for a week or two and then find out that we're going to be in a trading range on the market and go from a sell to a buy over a 1 week to 2-week period. And that's why I've kept it neutral. If we are going to, as long as we stay underneath this 4% or so and move a little bit sideways, maybe we can stay in a trading range. However, if we do see that spike, again, it's not going to be positive for the market. And I do think that, right at this stage, having some cash in your account is good. Again, like I said, with like Nvidia or some of these stocks that have already doubled, basically, I don't think you want to chase them here. But as you see some of those, and maybe the Microsofts or Meta, some of these things where you see them pull back, that you want to own for the long term, it'd probably be okay to go in and buy something. If you want to buy 100 shares, maybe you buy 20. And a couple of weeks later, if it's a little bit lower, you buy 20 more, something like that. And but there's no sense being a hero in a market like this. You're not going to catch the bottom. We're not going to catch the bottom. And as long as you have these outside influences on rates, it's kind of hard to predict exactly what we're going to do. Like I say, the best we can hope for right now is maybe a range-bound market, but to have that, we're going to need rates to kind of go sideways from here. That's about it for right now. We do have some more earnings coming out. A couple more retailers. I think Lowe's comes out tomorrow. A couple other big retailers are going to come out. That'll kind of gauge the strength of the consumer, see how he's doing. But the big story, I think, also is over the next couple of weeks, watch for stocks that you may own. Watch for some guidance as far as earnings getting trimmed, because that's going to affect their valuations.
If you have any questions for David or anyone at the MarketEdge team, feel free to send us an email at support@marketedge.com or shoot us a message in that chat box in the lower right-hand corner of our website. We'd love to hear from you. Any other thoughts, David?
No, I think that's going to be it. Again, we're neutral on the market. Let's just kind of see where the rates go here over the short term, and just don't be anxious to jump in. Just kind of see what happens here.
All right. Thank you so much. Have a great day.
You too. Bye-bye.